You've probably seen it too. A shiny new company goes public, the stock triples in a day, and suddenly it feels like everyone is cashing in. Except you. That's IPO hype. And it's powerful. The headlines, the social media buzz, the feeling that you might never get another chance like this, it all builds to one thing: FOMO. But today, I want to show you how to move from that anxious place to something calmer and smarter. Let's take Figma as an example. When it went public on July 31st, 2025, it launched at $33 and closed the day at $117. That's a 254% surge. Figma and selling shareholders sold about 36.9 million shares for roughly $4.3 billion, while company proceeds were about $1.2 billion. I watched it happen too, and yeah, it was exciting. But I've been on the other side of that hype. Back in 2021, I jumped in hard on a different IPO, a hyped EV company with big backers and very little revenue. I thought I was getting in early on the next Tesla. I'll tell you exactly how that ended later in the video. In this episode, I'll explain why IPOs feel so urgent and seductive, then walk you through the framework I now use to stay sane around them. We'll go over my 90-10 strategy and 3 other smarter ways to handle IPO investing, plus a case study with big names like Palantir and AMD. Welcome back to the club. Let's get into it. FOMO isn't a bug, it's a feature, especially in IPOs. Companies and underwriters create scarcity on purpose. Early allocations go to big institutions. Then the rest of us watch as the stock explodes at the open. You don't get in at $33, you get in at $90, and you're told that's still lucky. Psychologically, this taps into 2 powerful forces: scarcity bias and loss aversion. Our brains hate missing out, especially when it looks like others are getting rich fast. So we chase. But let's check the data. Jay Ritter from the University of Florida found that 60% of IPOs between 1975 and 2011 underperformed the market over 5 years. Dimensional Fund Advisors found that U.S. IPOs issued 2001-2018 returned about 3.7% annualized versus 7.3% for the Russell 2000 over the same window, showing persistent underperformance. So when you see a stock triple, remind yourself, you're looking at the exception, not the rule. Once I started thinking of IPOs like lottery tickets, not lifeboats, I felt a lot more grounded. So how do I approach IPOs now? I use what I call the 90-10 approach. It means 90% of my portfolio goes into long-term, diversified investments, like total market ETFs, dividend funds, and bonds. The other 10%? That's for exploring. That's where IPOs live. Let's go back to Figma. If you had $10,000 and followed this plan, $9,000 stays steady. With the remaining $1,000, say you bought 11 shares at $90. 3 days later, it's at $117. You're up 30%. And if it had dropped to $60, your portfolio only takes a 3% hit. You're still sleeping at night. But 90-10 is just one way. Here are 3 other options that can help you stay smart around IPOs. First, dollar cost averaging. This one's simple, but it works. Instead of jumping in all at once when a company IPOs, you spread your investment out over time, say over 5 months. If the stock price drops after the hype fades, you get better entry points. If it rises, you still caught some of the early upside. Either way, you're not putting everything on the line at a single moment. Let's say you wanted to invest $1,000 in a newly public stock. Instead of putting in the full amount on day 1, you invest $200 a month for 5 months. If the price drops to $60, then rises to $90, you end up with a better average price than someone who bought it all at the peak. More importantly, you've removed the stress of trying to time the market. You're following a system, and that helps you invest with confidence, not fear. Second, the 6-month rule. Many IPOs lose steam after the lockup period ends. That's when insiders can sell and the market gets flooded with shares. If you wait 6 months, you can dodge that volatility and get access to a few quarters of real financials. It's like letting the dust settle before deciding if the company's actually solid. Third, use an IPO-focused ETF. If you want in on IPOs without picking stocks, try something like the Renaissance IPO ETF. It holds a basket of recent IPOs. You're not betting on one company, you're betting on the category. You won't shoot the moon, but you'll reduce the risk of crashing back to Earth. These aren't complicated strategies, but they are powerful. And for anyone who's ever felt the IPO pull, myself included, they can make the difference between building wealth and chasing hype. If you want more detailed explanation of each of these, please leave a comment. Also, if you are already using other method, do let us know. Going back to 2021, I ignored everything I just told you. There was an EV company, maybe you've guessed by now. It was Rivian. The buzz was massive. Amazon had a stake, Ford was involved, everyone was calling it the next Tesla. And yet, when it went public, Rivian had barely delivered any vehicles. Disappointed? Revenue? Close to zero. Still, I was swept up in the hype. The IPO was priced at $78. By the end of its first week, it soared to $179. I thought I had picked a winner. So I went in heavy. No plan, no rules, just pure momentum. And then, within 6 months of its November 2021 peak, Rivian was down 75%, sliding below $23 by May 9th, 2022. I didn't just lose money. I lost confidence. I kept checking prices. I second-guessed every move. It was exhausting and emotionally draining. Now compare that to 90-10 approach. Just 10%, pre-decided, calm. No matter what happened, your portfolio will stay stable, and you will stay grounded. That's the power of having a plan. So how do you spot real opportunities before the market catches on? Let's look at two examples, Palantir and AMD. Both saw major price surges between August 2024 and 2025. But the clues were already there if you knew where to look. Palantir traded around $31 in August 2024. After launching its AI platform across more customers and winning defense work, it posted Q2 2025 revenue above $1 billion and raised guidance. Shares climbed into the 180s by August 2025. AMD followed a similar pattern. AMD ended August 2024 near $149. Management later raised 2024 AI GPU MI300 revenue outlook from $2 billion to $3.5 billion, signaling stronger demand. By August 2025, AMD traded around 170 to 173, about 15 to 17% higher year over year, as data center and AI momentum built. So what were the signs? First, surging demand in a future-forward sector. Next, upward revisions in revenue guidance. Third, major product announcements or contract wins. Fourth, analyst upgrades and bold price targets. Finally, an actual improving fundamentals, profit margins, earnings, and free cash flow. In both cases, investors who ignored the hype and looked at these fundamentals were rewarded. IPO frenzies will keep coming. There will always be another Figma, another Rivian, or maybe even the next big one, like Reddit or Stripe, stirring up headlines and investor buzz. But here's the secret. You don't need to win every wave. You need to build a boat that stays afloat. A calm investor has rules. A calm investor knows her allocation before the hype. And a calm investor sleeps well, even on IPO day. If you made it this far, here's your move. Next time a hot IPO drops, decide before it launches. Are you allocating 10%? Waiting 6 months? Buying an ETF instead? Whatever you choose, let it be intentional. Let it be calm. And if you're curious to see how I broke down IPOs of the year, Figma, check out my previous video. It pairs perfectly with this one and shows how a real IPO story plays out before it happens. Thank you for watching, and I'll see you in the next one.